guys, and glad to have you on board again today. We're on board for a long session because we're going to do kind of a global review talking about the stock market, recent volatility, what it has made for the crypto market, as well as now Elon Musk is apparently trying to flush away bitcoins. So we'll talk about that, of course, and trying to figure out how dumb price reaction can be inside a range, and of course, can we figure out that we're going to have enough information to process prices out of the range? Do we need to readjust the midterm to long-term vision for cryptos, or is this just stupid usual volatility in a range? Broad market first, and we're going to cover derivatives as well and correlated assets, WTI, Euro dollar, USD GPY, major coins, okay? We're going to have a look at Apple as well to try figuring out what are the likeliest outcomes in terms of structures for prices to come. So, first things first. We've talked about that for a long time. Volatility was low, but I've always made it clear that you shouldn't be just forgetting about the stock market. It would reactivate sooner or later, and when it would, of course, it would do it with some kind of a fireworks type pattern. It means lots of people are now wondering if asset prices are going to fall off a cliff, and there is the narrative behind it. Now we're talking about some kind of a taper tantrum in terms of monetary policy. Some central banks are even talking about rising rates to avoid inflation. All of these things are just, oh man, I've warned you about that. The narrative we had previously, in which, well, we have a recovery, but we still have fragile parts of the economy, so we still need to have heavy supports and so on. Yeah, sure thing, this is still going to be the case. But if you expect broad, free money, market policies and so on, this is not what we're going to get. Now we're starting to target money. Of course, there will be other stimulus packages and so on, but it's not just going to be opening the paychecks and so on. It's just going to be targeted money flows, though most likely not going to be profitable for the market, or at least not immediately. So that's, of course, the narrative we're going to switch into now, which means we've braced for the best. We have something good. Well, between good and best, there is a slight difference. Now, how big is it going to be in terms of market drawdowns? To make it clear and simple, my personal assumption has always been the same. We're probably going to pull back over the 2020 area, 2020 open area, which is to 3243 in terms of S&P 500, which means broad market drawdown, approximately 20 to 25%. We're going to approach bear market territory, which is going to frighten everyone, which is once again absolutely dumb. We have no reason to panic, definitely no reasons to. Do we have reasons to overexcite ourselves? Definitely not as well either. So the question we have to wonder is, what is the correction going to look like? Of course, everyone still have the recent wounds of COVID into our heads, which means, well, everyone just thinks we're going to crash out of this market. Well, sure, that's one of many probabilities the market can take to go from point A to point B. That's just not the most common one. Definitely not, actually. This is a bull trend. We had an alternate structure, which means it's not looking like the things you get used to it. Okay, we've made all of the breakout trades into the first wave, and then we created these contracting waves. Those I've warned you about, that time will be painful for psychology, that everyone will have a stupid bullish bias in the market that simply won't provide the expected gains until it breaks down a support and everyone understands they were wrong. That's what might be happening right now. People now start to figure out that risks overstated the potential rewards. So now everyone sees the risks and no longer the rewards. And that is how dumb the psychology is in the market right now. Like I said, we are correcting. So correction means the market on the overall is fucking bullish. Otherwise, we wouldn't even nearly have done such a bull market. So the bull run terminated. Yes, corrective territory now. How are we going to handle this? Like we stated, are we going to go for a straight line, kind of a reactivation of COVID? Well, it really doesn't look that way. That mostly depends on external factors, of course. We've piled up quite some risks in this bull run, so if for some reasons we had credit issues or stuff like that, this could fuel some more catalyzed downside potential. But until then, well, in a corrective territory market, you look for supports, you target these areas, you profit take your bear trades, but you still ride your way down. So the most conventional way of correcting a bullish wave is generally to retrace, first of all, to the previous resistance, which is, well, slightly lower than the current prices. And normally we are rebouncing to test over a first resistance. Once the resistance confirmed its build up, we generally tend to break a support. So that's the first thing I would notice right now, and then we look for other levels to target one by one. Afterwards, we generally, in a second stage, target moving averages, and we generally slip below these. So that would be my personal guess right now. In a worst case scenario, there's probably going to be catching up onto this moving average, and that would eventually terminate a first bear wave, very likely going to retrace us to the prices we might be trading right now, at least closer to it, for what is typically generally a second set of wave, going to the target, eventually overextending to trap some bears, and then we reactivate the classical consolidation structure, okay? So this would be, in my personal opinion, the standard way of correcting to try reaching out 3244. In this perspective, we would reach it out by the end of this summer. So a corrective summer, and we would eventually reactivate September or October or something like that. Okay, so consolidation. But what's funny today is that when you see the market behaviors, you start figuring out, well, what do we have in terms of sentiment? The dumbest thing as usual, of course, prices start to go down. What is the dumb money doing? They're buying. Of course, like we stated, the smart money is now selling. So smart money sells, dumb money buys. Yeah, sure thing, we can fuel some more downside. We can definitely do it. Now we finally have the... But the thing is that, yes, they're buying the market just as of the early pullbacks. This is the stupidest thing to do, of course. And now the smart money made its decision. We have crossed below the triangle formation we've talked about. So the message has been sent. The smart money is no longer bullish, and you rather like to follow it. So the sentiment is going bearish. But does that mean bear trend? Well, like we always stated, it isn't the case. We have a bull run, so we're stating for neutral territory, but we've terminated a fucking run that lasted for more than a year. So it's probably going to take a couple quarters to get to retrace it. Yet everyone now just assess how much they could lose, and they're just thinking red. Oh man, I just can't believe it. I just can't believe it. Okay, so patience is going to be required. Not trying to forecast the worst case scenario is, of course, very rational as well. Have some decent targets. Sure thing we can try reaching out to the next levels. But more importantly, I would like to point out something that lots of people have forgot about. Okay, in a bull trend, we somehow leave some tracks behind. The big tracks we've left is this open gap right here. This is going to be today's objective. We're definitely going to get to test it. But there is also one thing you need to understand. This could be a breakout gap, in which, no breakout gap, it's, damn it, what's the word in English? Rejection gap. So we've rejected the bull trend, which means as long as this gap is open, but this gap is open, we're fucking neutral. So I see everyone switching heavily bearish. Well, we don't know for sure. The smart money broke down the triangle, which means sentiment is deteriorating exactly the way I thought it would. But as long as we do not fill the gap, well, we could just rebound, look for third range boundary, which means if you're selling supportive areas, well, good luck on that. That's not what I would do. So I would look for this by the end of this week is all I care about. Looking at either we're going to fill this one or rebounce over it. Because if we were rebouncing over it, that means we're going to retest this one. Not necessarily fill it, because I doubt we can, but we could definitely rebounce. Don't forget that a market who reverses out of a bull trend generally does it by creating a range first. So we could range in here before eventually deteriorating the scenario to some more downside potential. All right? And yet, I see everyone being extremely bearish today. I think that's not the motive. The smart money isn't extremely bearish at all. They're just bearish the way I was. We have more downside potential than upside potential for quite several weeks, yet people was stupidly bullish. Now they understand, though they get immediately from one extreme to another, and I think it's not the appropriate decision to make. Alright, that's for stock market. Of course, I'm back into covering the portfolio, not stupidly, and of course, I still have no net bearish exposition for my portfolio now. I'm just covered, and I expect to look for what is going to happen with the gap today to figure out if I need to go net bearish right now or if I have to wait for better prices, like pure and simply technical pullbacks and opportunities to enter at better risk-reward ratios. All right, so of course the VIX pumped up. That's definitely something, okay? So as we can see, we do have some kind of trend lines in here. We broke this one. That was the usual pattern. But as we generally break a trend line, okay, we accelerate. And then what happens? We consolidate before actually going for some more bearish territory. So that's exactly what I think is on the verge to come. We've definitely reacted into the expectable area, which means this is really a hell of a technical reverse. Definitely smart money is handling the thing. So now that people might be switching extremely bearish, well, the smart money might be just stop selling. If people get irrationally buying all the dips, well, sure thing, they're going to put the pressure in and more pressure in prices. So it mostly, I think, depends on market making perspectives. The more stupid traders will try to buy, the more they'll sell and wait for most attractive prices and their stop losses to buy. But until then, well, who knows? You certainly don't know what people are going to do. I think the sentiment is mixed. News flow is mixed as well. So I'd pretty much go for bearish vision, but limited bearish, and I'll be ready to think about some potential price pullbacks. All right, so if it shows up, then of course I'm interested into letting the market digest for a few weeks eventually and trying to buy again on the VIX is eventually switching below 20. So below 20 will be my next huge reinforcement in terms of position sizing. This is where I'll be fully confident into short selling with decent position sizing. Right now it's just more like taking some gains to compensate for market losses, okay, to compensate for asset losses, because of course I have a bullish portfolio in the market, meaning I'm losing some money when prices went down. So I'm compensating for this pure portfolio management structure out there. Junk bonds have deteriorated in here, of course, as well, and we have plenty of room to the downside, but pay attention to this. Overlapping supports could be working as potential support, though of course we're supporting as a trend line right now, which means we're going to fuck it all up. So is there more downside potential today in the stock market? Yes, there is, but like we stated, pay attention to the gaps. If they act as supports, then of course we're going to change the structure. In terms of yields, well, pretty much still the same old boring game. That mostly depends on some stuff, but as we saw some inflation, of course, immediately we burst it up. Though we're trying to accelerate, the trend definitely already occurred, leading me to believe that the only thing we're going to get out there is profit taking. So we can get right up to 2% just to send the message and so on. We've got higher time frame resistant context on top of our head. So this is not an area to be bullish on yields. I think this is more an area of profit taking if you took that bet. So now I think oscillation, ranging feels like the most appropriate thing to come for yields. So I'm not bullish, bearish. Well, I think this is not an interesting area to look for. Lots of people are talking about yields now. I think this is not an interesting topic actually for smart money. WTI is instead, well, 2% drop to double top rejection. We've tried to accelerate, so big question now, are we going to accelerate again? That will be the plan if S&P 500 rebounds eventually on the gap, and in that perspective could eventually extend to try breaking above the resistant context. That would be a $72 and above mark, and in that perspective another reversal trade might be showing up in here for experienced traders only. Otherwise, this is pure and simply just yet another stupid range in which we double top, and the question is, are we going to just double bottom later on before going higher, 75, or of course are we going to double top reverse, which is going to open double the downside potential to my target areas, in which I think interesting long-term areas to look for buying entries would show up. Remember once again that there is fairly freaking high storage prices on WTI, which means a contango effect could totally change the risk limitations you would have out there. So if you ever intend to buy WTI, make sure you talk about it with an experienced trader, because there are plenty of more complex stuff behind that. Precious metals, of course, lots of interesting things. We've reacted and retraced right back to resistances. Everyone was bearish down there. It was just absolutely staggeringly stupid. Of course, buying the dips was the thing to do. Now that we've retraced the resistances, of course, bulls are looking on some gains. We're on a bearish context and we just retraced right up to the 50%. So, of course, in here is not an area to be a bull, but it's not an area to be a bear either. I don't think that we're going to reverse out there, or at least I see very limited potential for this. So my personal call would be, I don't know, eventually retracing a bit, accumulating on lower time frames possibly, but I suspect the breakout is going to come out of this area. So do we just do it straightforward, reaching out for the resistant context and the previous third range boundary as a technical cluster, or like I said, do we range and do stupid upside downside potentials until we actually find the strength to break? I just don't have that answer. All I would say is that I'm not interested into XAUUSD anymore. Buying the low points, definitely I was. Now I am not. I just think anything that can happen out there is dumb. So either we reach out to my interesting taking profit areas, or we just do other stuff in between. Same thing goes for silver for me. A lot riskier, but this guy has much more upside potential in the long run. So that has been my preferred state, but I like both of them. Okay. A quick run on forex and then straight up to cryptocurrencies. Pay attention to a potential third range boundary that could be rejected exactly at the previous third range boundary level for euro dollar. I don't think there is that much risk for this because we totally have no signals out there and the context is still fairly much bullish in here. So sure thing, we could eventually deteriorate and retrace right back down to 1.16. But that doesn't seem like this is the motive. Of course, we have made mature range down to 38% Fibonacci. We had trend following fucking signals. I still don't understand people that were bearish on this. I was bullish, and I can definitely tend to say that I have more upside potential to come. But just like gold, I think stupid things can happen in the mid area of the range. I wouldn't nearly buy a previous third range boundary retracement. So this is more like I don't give a fuck about what's going to happen now. All I care about is when we'll find the strength to retrace and finalize this bullish trend on a final excess, potentially 1.26, 30, whatever. But these are the areas in which I would like to profit take and terminate my midterm to long-term euro dollar scenario, things that I have started last year. USD/JPY, same thing on the opposite direction, but this one is a lot trickier to figure out because of the yen, which is an overly indebted country, but still, that's the topic for another day. So now, of course, investors are much more cautious buying into yen because of this heavy amount of debt. But I still tend to believe that at some point it will still be something. So a lot more hesitation, so I wouldn't be too aggressive into USD/JPY, but I still tend to believe that a final flushing pattern going at 95 or below is expected before actively finding a suitable buying market bottom for USD/JPY. So I am bearish, but not fully confidently bearish. I think that this is way too much for a retracement, so it really rose some concerns on my end. I'm not reinforcing like hell. I still have my plan and my confidence into my plan, but, well, I wasn't expecting such a rebound, so I have to account for the risks. All right, that's pretty much all about it. Apple, finally, quick shot on this one. So depending on the weekly candle close, if Apple was closing weekly tomorrow below 126, that would be a very bad sign. But still, if you look at shorter-term signals in the appropriate context and time frames, well, we're trading with this, okay? This is a trend line. I doubt we're going to rebound out of it, but it's still, I'm not going to sell a dynamic support on Apple. So buying in here sounds absolutely stupid to me. Selling, well, definitely not either. This is the area where I sold, and I'm pretty damn stand for it. Now that we are testing the first supports, this is validation for me. I had bearish signals on a bearish context, so reversing inside the context with bearish signal tells me that sure thing we have more downside probabilities than upside, so I wouldn't definitely buy this. But does that mean I can increase my bearish position sizing? Definitely not. So I'm letting it ride, and I'm really curious to see what's going to come out of this, because of course this is definitely a trend. Moving averages are far below the context, so this could just be an intermediate consolidation, like 2 sets of waves retracing 38% on higher time frames, or 23, and this could just be a trend following opportunity. So I'm still not excessively bearish on Apple. I'm just worried about the fact that people bought into this thing like it was the future and so on. Well, it actually has been the future for 10 fucking years. That's the reason why I'm not following this narrative. But still, I might be wrong, and I know the dangers of trend following into these things. This is definitely a bubble, okay? So bubbles can keep up longer than you can be solvent. So of course, if this thing was just doing this and then reactivating, I'm out the fucking game, because this can go real stupid, okay? Still, so cryptocurrencies now, because it's going to be a long shot today. Okay, so Bitcoin first. Is it like the end of the world? Well, I don't nearly think of it that way. Is it an hesitating market? Sure shit it is. Okay, we've made our plans long ago, so you guys were acting rather than reacting to the market. I told you that the trend, well, forget about it for a little while, okay? The high points and so on is not going to happen. We're just going to boringly range into this. Reason why I wanted you guys to figure out about 2 clusters. Closer to the 23, closer to the 38. Don't overthink things, okay? I've also warned you about the fact that we had a we had a single print area in here, which means generally this can act as a support. So this is undermining the probability to go to the 38%. This is the reason why I've always invited you to make some tiny calls over the 23 area, okay? Just in case we never get there, because there are some technical clusters inviting me to believe that we will not get there. That doesn't mean we won't. This is just indications that we have reasonable probabilities that not to get there. So you rather like to start buying slowly in here just in case we never get there, because if you're still among the guys that were waiting for 24 in here, you never got the price. If you're still among the guys who were waiting for 39 to 40 in here, you never got the price. So if you endlessly keep waiting for attractive prices in a bull trend, you're just going to stay the fuck away from the trend forever. So is there still a trend? I've always made it clear, yes, we have one on a weekly chart time frame, which means we can trend follow 4-hour charts. And guess what we've just reached out to today? The moving average. Oh, god damn it. So for trend followers, this is a pattern we know. Context and moving average on the cluster. Moreover, we're trying to accelerate, so that acts as a signal for me. Of course, we have no signal on the momentum, but I don't give a fuck. This is more than enough for me. I'm buying the moving average straightforward. This pattern has an associated stop loss, has to be below the higher time frames context, which is in here, and generally you should see a market bottom corresponding to the level to secure your stop loss, okay? Okay, so normally we can buy this moving average with a stop loss in here. Problem, where is this stop loss? Right where the 38% Fibonacci is. So things doesn't look right that way, which means your next buyable area is where you're supposed to push the stop loss. You're not supposed to put the stop loss into attractive buying signals, okay? So something in here doesn't feel appropriate. So if you're buying the moving average, definitely don't put a 2% risk into this single trade. Because of course, if you get stop loss in here, well, you just lost 2% and you're not going to try again. That would be stupid. So I think putting just 1% in here and doubling the stop loss is way smarter of a decision. So that also leaves you some money to eventually buying the 41K area if for some reasons we're just rebouncing out of it. Okay? So take just half the initial risk you would take in here. What does that mean for me? I'm still buying cryptocurrencies, but I bought with 30% of the available cash I have, which means I'm still having 70% available, and I'm still going to use that 70%, increasing that pool day after day into short-term intraday trading, okay? So I'm arbitraging my range, I'm buying the lows because that was the goddamn plan, I'm trend following because I still believe there is a weekly trend, everyone just called for Bitcoin to be dead because Elon Musk just said so, Jesus fuck, we're in a range, I always told you not to listen to the news flow, so I'm applying my goddamn rules. I don't give a shit about Elon Musk's comments overnight. I actually like it. Normally, when you're buying the bottom of a range, do you really expect to get bullish narratives out there? No, you expect the market to panic sell. So that's what I wanted. Bearish narrative this morning, moving average tested, sure shit, I bought some coins. Which ones? Well, of course, I had a plan. I knew which one I would like to buy, and I just executed the plan. I needed some Nexos for for special purposes of increasing lending rewards on the Nexo platform, so I got to buy these guys. I wanted to buy Theta, so I got some. I got into Philcoin, not very attractive prices, and got really tiny position sizing. Got myself back into eGold, into Elrond, sorry. Got myself into this guy. I don't really know if it's really hell of a thing, but I wanted to try it out. No, I no longer have ETHI. I reinforced KNC for 25% of my existing position, so really a tiny increase, pretty negligible. And I took some monos as well. Well, that's it. Do I need to explain a lot more about that? No, I shouldn't. So I just explained my plan previously. I had some coins I wanted to reinforce. We are down the bottom of an area of potential supports for Bitcoin, so I'm executing the plan with 30% cash. So the position sizing on it staggering. I bought with cash, no leverage, no margin trading, just putting some money into some coins and see what it does within the next few days. If they keep falling off a cliff, well, I wouldn't even change my mind. I know how dangerous that is. Just taking a few examples so you understand. Like, for example, Philcoin. When you're buying such a thing, okay, you need to understand the complexity of it, okay? Of course, I missed a shot. I would like to buy the dip overnight. I was just slipping, okay? So I bought in the morning. Now this thing either going to go for a third range boundary, very likely going to retest this level, or option number two, it keeps falling off the cliff and it goes to 50, which is the area I intend to buy as well. So just the same exact scenario as Bitcoin. Buying in here means where do you put the stop loss? Normally I should be putting the stop loss out there, but that's the area I'd like to buy. So very tiny position entry in here so that if it rebounds, I'm not just out of the trend. And if it keeps falling off the cliff, I'm going to have much more attractive prices to get in. But in both case scenarios, if it goes there, I'm going to need some specific signals, because that means this thing will have lost more than 80% or 65 or 75% of its value, well, in just a month and a half, just like after gaining it in 1 month and a half. So if this thing just flushes up and down, that means there is no trend with this thing. It's just a stupid boring range, and I will trade it as accordingly. So as of right now, I still think this guy might have the potential of a trend, but it has to show some strength. If it does not, well, that's a range, meaning I probably just got into fairly uninteresting average prices. Well, if you buy average prices in a range, that doesn't mean you've made a pretty bad deal. Okay, that just means you've made a pretty average deal, which is still not bad, okay? So I'm not crying for this thing. I know that if the market is rangy, well, we could go much lower than that. So it all depends on the Bitcoin dominance, okay? Bitcoin dominance, sure shit, is overextended. I don't know where this thing can go. Is it strong enough to go lower? Well, potentially. I never thought we would go that low, to make it straightforward. We're really away from any rainy standards I have in mind. We've gone real straight line for several weeks. Are we going to keep it going because we changed the narrative into an alt growth? Well, sure thing we can. I don't know. Are we going to rebound to some more neutrally balanced BTC versus altcoin? I goddamn don't know. So I'm not making huge plans. And that's what I'd like you guys to understand today. Jumping on board because I have trend following opportunity in the Bitcoin and a still existing weekly trend, yes, I have too. Does that mean I have to buy hard because that's the craziest opportunity of the decade? Definitely isn't. So I'm jumping in really tiny position sizing with lots of available cash to reinvest at lower prices if the opportunity is offered down the road, which means this is a first viable context, very risky. So try to be humble. If you go in with tiny position sizing. If you just don't want to go in, I would totally understand that, but just don't come cry to me if you've missed another trend following opportunity. As of right now, the trend's still existing. I think it's more neutral than very extremely bullish, but still, neutral means you rather like to buy the bottom of ranges rather than selling them. That being said, see you guys over the weekend, in which we're going to explain a little bit more about that.